I've titled the talk today, Reasonable Benefits Reborn. Most of you would have probably remembered when we had the reasonable benefits, and in fact what we have being brought in now is a lot more reasonable than what was introduced in, I think it was about 500,000. So from a point of view of if they were going to be restricting what we can have in superannuation to be providing us an income in retirement, what we are going to be getting is a lot more reasonable than what if the old reasonable benefits had stayed with us. That's my agenda today. That'll become address most of the things, and one of the biggest important things to understand is how this pension transfer account balance works. If you can imagine from a point of view of the way that this pension transfer account balance is going to work is a bank statement. On your bank statement you've got your credits, which are your deposits, which increases your bank account. That's on the right-hand side. On the left-hand side, you've got your debits, which are your payments and your bank fees, and that's what decreases your bank account. In this case, the pension transfer account gets increased again by credits and decreased by debit. So it's exactly the same sort of situation. The big thing is to understand what is it that really are counted as credits. And there is more than the three that I've got on the screen, but these are the major things that you'll come across. There's the existing pensions as at the 30th of June 2017. Whatever those values of those pensions are as calculated at the 30th of June, that will be the first amount counted to anyone's pensions transfer account balance. After that, it's any pensions that are commenced after that date. So amounts transferred from accumulation into pension account. And then the other one, which I'm hoping, and in reality, no super fund member should end up with a SMSF be exposed to this, is when you exceed the 1.6 million, there is some penalties involved and there is an interest calculated on the excess. So the most common credits or increases to the pension transfer account balance will end up being pension amounts at the 30th of June and amounts rolled into pension. And then the most common debits ends up being full commutations or partial commutations. So it's a very simple equation. Amounts in pension, amounts rolled into pension, and amounts taken out as commutations. One thing that is not counted as a reduction in the pension account transfer balance are pension payments. So from a pension payment point of view, that does not affect whether you are over or under the 1.6 million, because people can you may be at 1.6 million at the 30th of June, but there are situations when you can fall below that. And that's only able to be done really by full or partial commutations. And then the other big thing is that doesn't affect and increase, which a lot of people have been worried about, your pension account transfer balance, is income. So if at the start of the financial year you have 1.6 million and you take out your minimum pension, and so that would end up being, say it's $80,000, and your fund earns $150,000, your pension account will have gone up by the difference, but there's no effect on your pension account transfer balance. So that's an important thing that everyone needs to understand going forward. One of the good strategies that can be used is that you only ever should be drawing down the minimum pension payment. Where extra money is required to fund a lifestyle, that should either be done first of all from money that may have to have gone into an accumulation account because you're in excess of that, and if you're 60 or over, that money's coming out tax-free. Or if for some reason you've exhausted that, you end up having partial commutations from your super fund. A lot of people thought the re-contribution strategy was dead. Under the re-contribution strategy, take money out of super that would have been taxable and you put it back in and it becomes tax-free. Even with this new pension transfer account balance, the re-contribution strategy can still be used. But again, like most things, it comes down to timing. If you're at 1.6 million and have the ability, let's say you're 61, 62, and you have the ability or want to be able to have an increase in your tax-free super so that your beneficiaries of your estate won't be paying as much tax, you could have a partial commutation in June of 1 year of 300,000. It comes out. That automatically means your pension account transfer balance has gone from 1.6 to 1.3. And then in July, and that's the important thing, because the date when your pension account transfer balance is decided is the 30th of June every year. So take out 300 before the 30th of June, and then in July you put another 300 back in, you're back at your 1.6, but you have been able to end up increasing that tax-free superannuation. Now, the moves to make before the 30th of June, one of the most important things is that you've got to be able to work out where you're at. And a lot of the actions that will need to be taken should be taken by your SMSF service provider. Because the way that the taxation and accounting system works for self-managed super funds, especially where there are managed funds involved, it's very hard to establish what a member's account balance is until September, October, November, when all of the tax statements have come in. So from that point of view, the documentation that needs to be prepared before or doesn't even need to be prepared before the 30th of June, but for my clients, just to give us a bit more of a sense of well-being, that so the tax office can't say we were doing anything too much to minimise tax or assist our clients, is that we're actually having letters drawn up now that our clients will end up signing that basically instructs the trustees of the super fund that once the members' balance have been calculated and their balance is assessed, and any excess over 1.6 million, the request is that be a partial commutation and roll back to accumulation. With that documentation in place, no one should end up being in excess of 1.6. And so from a point of view of the things that you can really do before the 30th of June, there's not a lot, unless you have a situation where we've got one member who's well in excess of 1.6 million and another member under it, and there's the ability for them to take the money out and have it recontributed. Apart from that, there's not a lot many of things that can be done. When you look at the 1.6 million pension account transfer balance, we've got the people who could be below it. Possibly most of the people in this room will be above it. For people who are going to be below it, it's going to become even more important to use an old strategy that was used when we had the reasonable benefit limits the last time. And under the taxation legislation, you're able to transfer up to 85% of a concessional tax-deductible contribution that's made to your spouse. So where you have a situation, and it'd be a good thing to be letting any of anyone know who may be below 1.6 and a lot younger, the sooner they start looking at this, and as is often the case, one of the members of a couple has not been working and earning as much as the other. For the one that has the lower superannuation as a result of that, the one with the higher superannuation should be at a very early stage starting to transfer 85% across to even it up, because there'll be nothing worse when you have one person reaching retirement with 1.8 and the other person being down at 200,000. And then you've also got that recontribution strategy that can be done at any time going forward, as long as the person who's taking the money out has met the condition of release. Now, for anyone with more than 1.6, it's vitally important that if you want to get the maximum benefit from the capital gains tax concessions that have been brought in as a part of this legislation, is to use the segregation method. And I'll be able to give you the reason for that because the way the concession works, you get 100% of the concession if you use the segregation method, whereas if you're using the proportional method, you you don't get the full benefit. The other thing will be is going forward, if you've had to split your fund into two components being pension and accumulation, the idea will be to have those assets that you believe are going to increase the most in your pension account and maybe the higher income non-capital growth assets in your accumulation. Again, the reason being is you've got a situation where the capital growth, the profits, can effectively end up meaning that you'll end up with more than 1.6 million in your pension account because, again, accumulated income doesn't get counted in the transfer account. There we go. There is also another possibility of looking at setting up or transferring the accumulation account out of the self-managed super fund or setting up a new one. I know the tax office has come up saying they're going to be watching this very closely for Part 4A, for where they can say the only reason you did it is for tax reasons. I've already come up with a couple of reasons why you would be able to get around that. But one of the big things is the choice is using another SMSF that you set up. There are some clients of mine that have two super funds already, so it's not going to be, the tax office is not going to be quite attack that situation as much if a new super fund is set up after the 1st of July. But the alternative to another self-managed super fund is a good quality industry fund. And when you look at the cost of a self-managed super fund, where, and I'm not talking about the cut down, no advice type of versions that are around that are about the 1,000, and there are restrictions often placed on what you can invest in or what accounts you must use. That you're looking at normally about 2,000 to 2,500 for a self-managed super fund for an administration fee. When you compare that to an accumulation account, where the pure administration fees for some of the better quality industry funds is $80 to $100, you'd have to be having a really great benefit or really wanting to have great control over your investments to be setting up a second SMSF to have the accumulation account in it. And the reason why you would want the accumulation account in another fund is because the example here, we've got an SMSF with 3.2 million in pension accounts, 1.6 in accumulation. The income for the year is 160,000 with realised gains of 120. From 1 July, anyone that has a superannuation pension account or a superannuation worth more than 1.6, they cannot use the segregation method for that super fund going forward. Now that ban starts July 1. It doesn't start prior to. So we can still use segregation till the 30th, but you can't use it afterwards. So the proportional method ends up applying, and the proportional method in simple terms is the proportion that the accumulation accounts are in a super fund as a percentage of the total value of the fund. That is what is the income, that percentage is what ends up being taxed. So in this case, we've got effectively a third of the 160s taxed at 15%, and we've got a third of the capital gain taxed at 4,000. And then you can see it just flows through. It's a very simple example. Whereas in this case, what we've done is we've kept the growth assets in the self-managed super fund with the pension account, and we've got the other in, say, an industry fund. And in this case, the self-managed super fund's made 80,000. The extra 40,000 has been made in the accumulation account. We've kept the 120,000 capital gain because we did that specifically by making sure we got the assets right. And then there's no tax payable there. So what we've got is the accumulation account in a separate fund. It's ended up with income of 80,000 and the tax payable of 12,000. There is a net benefit. It's not sheep stations, but in this game, the idea is to get the 101%ers. You're never going to get a Tats Lotto 100% solution to anything. So this is basically the reason why it can make sense to have the accumulation account in a separate fund, purely because of the way proportional taxation is going to work. The other interesting thing too is, I don't know if it's been highlighted that much, you can end up getting the tax concessions for the capital gains for assets being transferred back to accumulation. But if you keep your accumulation account in the same self-managed super fund and make the capital gains down the track, whatever the proportion your accumulation account balance is of the total fund will end up being taxed. You'll have protected those that have been transferred back, but there was still going to be a taxation situation. Now, to be able to gain these concessions, the reason that they are being claimed can't be for tax minimisation. In other words, it can't be a contrived situation. The investments must have been owned for the super fund for the period from November when the legislation came into effect up till the 30th of June. The super fund must make a non-revocable election to claim the CGT relief, and the super fund must lodge its annual return. The important thing to also understand with this is you don't have to use it, and you don't have to use it for any or all of the assets. So it can be done on a case-by-case basis, and it really needs to be done once the accounts have been finalised and looking at, from a point of view of, what are those assets that I believe have probably reached full value. I want to protect that capital gain and use that election then. So from the segregation method, going back, the reason why the segregation method is so much more beneficial than if you choose to have the proportional method. Under the segregation method, for the assets you select to go back to accumulation, 100% of the gain is protected. If you're using the proportional method, and we go back to that previous example of where 1/3 accumulation, 2/3 pension, 1/3 of the capital gain that the concession is being applied for is taxable. And tax is either going to be paid in the 2017 year or it's going to be paid when the investments are sold. So therefore, that's why segregation is important to use. The other interesting thing to note is I've had a lot of people saying, well, how do I end up applying to use the segregation method? If you currently have a fund which is totally in pension phase, you are automatically using the segregation method. The tax office came out when there was a bit of confusion about these things and they issued a ruling about this, that they deem every super fund that's 100% in pension phase to be using the segregation method. So there's nothing that really needs to be done. It's there available for you to be used. This is an example of the capital gain. You'll be getting these slides. I don't want to take up too much time. I want to leave plenty of time for you for questions. Again, the important thing is the asset selection. For the assets that are going to be left in the pension phase, you want to be getting those that are having the best chance of increasing in value. For those assets that are already at full value, they should be transferred to the accumulation account. And the final thing, because we're all coming down to investment selection and what you're doing with assets, a relatively new phenomena. I mean, it's been around for quite a while, but for when you're as old as me, it's new. If you didn't want to invest directly in shares, you previously had to use a managed fund. The problem with managed funds are quite often there's no transparency. In fact, there's no transparency at all, and people can say that they're an active fund manager when in actual fact they're not. SMAs have come in, and the big difference with an SMA is that the ownership of the underlying investments is with the investor, not with the fund manager. So when you have a managed fund, if you decide that you don't like BT because they haven't got it right for 20 years and you want to swap to OnePath or someone else, you have to sell those investments and invest with the new fund manager. With an SMA, you can have a fund manager looking after those investments. If you find they've gone off the boil, you can actually change the fund manager, and the assets are still there. There are also other benefits when it comes to the imputation credits. So it's also a lot more transparent because you can see what they're investing in. So the SMAs end up being a very good way of giving greater transparency and control of the taxation situation. That brings me to the end, and I'll hand over to the lovely Ron and look forward to your questions a bit later.